Hey there, everyone. Dave Keller here with Market Misbehavior, and the S&P 500 is currently trading below our line in the sand of 5850. We've been talking about this level for quite some time. The day has finally come. We're currently trading below there. Today we're going to talk about some potential downside targets we've developed based on that follow through to the downside, assuming that the S&P closes below 5850 and we see further deterioration at the beginning of next week. What might be next for our major equity benchmarks? What's funny is we're looking at the markets here today on Friday, January 10th. A lot of red, particularly in the growthy sectors like technology, but also in value and more cyclical sectors like financials, like industrials, and even healthcare. So we're seeing sort of a broad decline here. The breadth measures really have been deteriorating since mid-December. We've covered that a lot on our daily market recap show called Chart This with Dave Keller. But we're certainly seeing that sort of accentuated today with the break of support with the for the S&P 500 combined with some of the key deterioration in some of the most important sectors to follow. Let's look at a chart of the S&P 500. We'll talk about some different ways to think about downside targets. Now, I'll tell you first off, what's most important is that we actually close below 5850. Now, earlier in the day, the S&P got down to almost 5800, but here sort of lunchtime Eastern time, the S&P is actually rallying a little bit back toward that 5850 level. So this video, of course, is assuming we get a valid close below that point, but I thought it'd be good to get ahead of it and just think about some potential downside scenarios. And you think of this sort of market, I would say like an if-then statement. If we break 5850, then what's next, right? The reason why we wait for a valid close, by the way, is exactly why in third week in December and then at the end of the year, beginning of this year, why we are not kind of shaken out of the overall bullish sentiment just yet. You know, on 2 days so far, or in the month of December and then into early January, we actually traded on an intraday basis below 5850, but close back above there. And that's key, right? That's important. What you have to remember, anytime on a daily chart you have a support or resistance level, trading through it on an intraday basis is not enough. You need a valid close below that level, and then one would argue follow through. And, all of my mentors, and I'm thinking people like Tom DeMark, Larry Williams, John Murphy, all of those people really have some aspect of a follow-through day in their toolkit, meaning, just trading to or through a certain level is not enough. You need follow-through. You want to minimize whipsaws by just making sure that there's additional momentum in the direction of the breakout. So step one, we need to close through that level. And then the second step, which we can only answer at the beginning of next week, is if we see additional follow-through, right? So we close below 5850 and then additional follow-through. But let's assume now that we get that. Let's assume that either Friday closes below that 5850 level or we get a close below 5850 early next week. And that line in the sand is now broken. Then you need to start to think about some potential downside targets. There are different ways to think about this, right? I would say number one, you can use what's called a price pattern objective, looking at the framework of the market as laid out by a particular price pattern and use that to project what a new downside target could be. We'll talk about that. We could use traditional support and resistance, just look at where the market has bottomed out before and assume that there may be additional buyers coming in there as well. We can use other indicators like moving averages, maybe Fibonacci retracements, right? Other sort of indicators that could help us anticipate where we might see an inflection point, where we might see some buyers come in. From here on out, if you assume further deterioration, it's all about how low we go before some value-oriented investors, some swing traders start thinking, wow, that's quite a dip. Now is where I want to start to buy in, at least for a short-term rally. That's what's going to cause that next swing low to actually play out. So let's go through each of those one by one. We'll start with the price objective as developed from the price pattern. Now, this analysis that I'm sharing with you here really is based on the foundation of price patterns as described by the Edwards and McGee book, sort of the Bible of technical analysis, written in the mid 20th century by Ralph Edwards and John McGee. It's really a foundational work for the technical analysis community, really putting into print all the different patterns that we would look for, how to define them, how to confirm them, how to use them to anticipate what's coming next. By the way, that book, along with some other really great reads, have a point of special place on my market misbehavior recommended reading list. You can go to marketmisbehavior.com/reading list if you want to find that book, along with some others that could help you improve your technical analysis knowledge. So how we think of this pattern. So I would say, I've been describing this as sort of a head and shoulder-like pattern, or a head and shoulder-ish pattern. It's not a perfect one. I don't think future textbooks will include this particular S&P 500 chart as an idealized example, but I would argue it's pretty close and enough that I think it's a valid way of interpreting the price action. What a head and shoulders top really means is that you have a peak, a high surrounded by lower peaks or lower highs on the left side and the right side. Now, an ideal head and shoulders pattern has a clearly defined head, a high above the other highs, but then has symmetry, right? So the left and right shoulders should be about the same because that's what really confirms that rotational pattern. Here we actually have some differentiation between the left shoulder, which is a very classic kind of gap up into a new swing high just above 6,000. And then on the right side, we actually have a couple highs, right? At this point around 60.50, another one around 60.20 before we rotate lower. So, it's not a perfect symmetrical pattern, but in terms of the time duration and the distance between the head and the shoulders, I think it's pretty good. Now, what's important about a head and shoulders top is to focus on what's called the neckline. And I'll call a bit of a foul on myself because technical analysis purists may say, hold on a second, you actually need to make that the neckline, right? You need to take the lows between the two peaks and use that as the slope of the line. So we really need a valid close below that trend line before the actual head and shoulders top is confirmed. I'm a little less picky about that in this kind of environment because for me, the line in the sand technique that I'm talking about is basically picking a level. And it's very easy to set a price alert on a specific level to just think as long as the S&P, whatever chart you're looking at, is above that point, conditions are okay. If we would start to break below that point, then I need to take action. And I think when you start drawing lines with different slopes, it's a little more subjective and it opens yourself up to a little more behavioral biases to sort of, do some wishful thinking analysis and interpret the chart however you want to interpret it. I find a specific level that you can set orders to, that you can set alerts to, that you can hold fast to. I think that ends up being a much more meaningful way to interpret price levels and use them in a more objective fashion. So 58.50 is the level. I'm sticking with it. And so again, what do we do to actually project a low? So generally speaking, you take the height of the pattern and then you subtract it from the neckline. So, again, using this particular chart as the example, what we would then do is say, all right, let's make this a trend line. Put a little arrow. Okay, so this is the height of the pattern kind of here, and I'm just doing a kind of slanted line so we can see. So that's the height of the pattern, and then we take that same level and we project it from the low. So what this is basically saying is the pattern goes from this point around 58.50 up to 6100. It's about that high. So we have a similar move to the downside. So when we break, or if we break support, then you project an equal distance below those levels. So that would yield a downside target right around 5,600. And as a preview of what we're going to talk about later in the video, that lines up almost perfectly with the 50% retracement of the August 24 low, which is the last kind of major swing low up to the December peak. So interesting relationship between the pattern objective and a Fibonacci retracement level as well. Some other indicators kind of right around that level at the same time. So for now, that's the first way we can think about a potential objective, and that's sort of the base case that I think makes sense here. If we would break below 58.50 and have a confirmed follow through at the beginning of next week, I think that clears the way to the next downside objective right around 5,600. I'm going to talk to you about a couple other indicators and how they relate great. As a reminder, though, I want to acknowledge that this video is brought to you by Seeking Alpha. Seeking Alpha is a fantastic website. As I have rotated from an institutional investor community to working more with individual investors, it's been a lot of fun exploring some of the products that are really more designed and geared for individual investors. And I was super impressed as I was learning more about Seeking Alpha over the last couple of years, and particularly recently as I was able to meet Steve Kress, who's the head of quantitative strategy at Seeking Alpha. Talk to him about the quant model that he designed and that he's currently using. You can actually import a portfolio. This is a test portfolio I'm showing you here. But you can actually import a portfolio from a brokerage account from other places. You can run a health score and actually take your portfolio to the doctor, identify some potential strengths or weaknesses, which is exactly the type of way we would use quantitative models for a large money manager's portfolio. We'd use quantitative models to sort of look at all the holdings and focus on the real opportunities for improvement. They have a bunch of ratings, proprietary ratings from Seeking Alpha and some others as well. And you can also dig into things like dividends and think about the tax implications of some of the income you may receive from holdings in your portfolio. If you sign up now, go to marketmisbehavior.com/Seeking Alpha. They have a special deal going on here through mid-January. You'll have access to the Seeking Alpha top stocks report, looking at top stocks based on their quantitative methodology. And there's an article coming out here in the next couple weeks, which will go in detail through some of those top names with some upside opportunity based on their quantitative methodology. So again, go to marketmisbehavior.com/Seeking Alpha. If you use my link, you can get a better deal. It doesn't cost you anything more. You actually get a better deal than normal, and helps me make Market Misbehavior awesome. So I hope you'll check it out. All right. Going back to the chart of the S&P 500, so step one, we have the height of the pattern, projecting that from the lows. And again, that gives us a downside objective around 5,600. Now let's talk about a couple other indicators, right? I mentioned the Fibonacci retracements, and again, this is a little subjective because it depends on where you actually want to draw the level. So if I would draw the August low, which I tend to use the most significant low based on my interpretation. I think that August swing low is the biggest drawdown in 2024. I think it's a good way to think about this up leg from the August low to the December peak. If we then go 38.2% of the way down, that's 57.25, and that might be an initial short-term level to think about here. That also lines up pretty well with the swing low in late October, right around Halloween. But then below there, the 50% level lines up really well with our Head and Shoulders measurement around 5,600. The 61.8% level, which is often sort of the terminal move after a big sell-off, would be just below 5,500. So that's another one that I would keep in mind as well. But Fibonacci retracements, I would say the fact that the 50% retracement lines up so well with the objective, call that a confluence of support where multiple indicators are kind of in agreement at the same point. Third thing I would tell you would be moving average support, right? So look at the 200-day moving average. The S&P hasn't touched the 200-day for a long time, right? For most of, if not the entirety of 2024, we didn't even get near it for the most part. If we would see that sell-off that I'm suggesting is most likely going to happen, if we get that break below 58.50, the 200-day moving average could certainly come into play. It's currently around 55.70, but given how long it might take for the price to come down, and given the general upside slope of the 200-day moving average, that most likely is going to be right around 5,600 by the time the price would come down there. So here you have three different approaches: the Head and Shoulders top measurement, the 50% retracement of the August to December rally, and the 200-day moving average all around 5,600. So that, for me, is a pretty reasonable downside expectation. Now, it's worth noting, I think things like objectives, targets, I think those are interesting. I think they give you a framework to start to think about, and that's how I use things like Fibonacci retracements, just to get an idea of what levels may come into play. But I will tell you what's most important on the chart of the S&P 500 is not trying to predict some future level. It's correctly interpreting the trend, right? So what happens to the price between where we're at now and where we might go later, that's what's most important. That's what you really want to pay attention to and follow, because if we see some interesting divergences, right, where the price goes lower but the momentum improves, that might tell us to think a little bit differently about potential support levels. So pay attention to trend, most important. Price is most important. Price is the most important data point to evaluate. But hopefully these downside objectives gives you an idea of where we might anticipate support and where we want to pay extra close attention to things like candle patterns, momentum, and other techniques in the technical toolkit. I hope you found this an interesting exercise thinking about potential downside targets in the S&P 500 using a couple different methodologies. Again, this is assuming we close below 58.50, which as we're recording the video, we're almost exactly at that price point. So, to be determined, but I would say, again, wait until the daily close. And if we do get a confirmed close below 58.50, I think that unlocks these potential downside targets. Let's watch the price along the way. And I hope you will follow me on my daily market recap show called Chart This with Dave Keller, because every weekday after the close, after the trading day around 5 p.m. Eastern, we will be checking these moves out and tracking day-to-day action in the S&P 500, along with a lot of other really interesting charts as well. For Market Misbehavior, I'm Dave Keller. Have a great weekend, and remember, it's always a good time to own good charts.